whenever we analyze data series, and I know you definitely know this, Lyn, because you do a lot of data analysis, and you typically use American data. And you do that for a number of different reasons. One of them is just very practical because it's there, it's available, and it's so easy to work with US data compared to many other countries. But there's a huge survivor bias. You're looking at US data. Well, there's survivor bias because the US stock market did so well. The US, the superpower, like a lot of tailwinds going for it. How US got out of World War I, World War II compared to, say, Europe, for example. And so if you look at those stock markets who survived, you have 3 stock markets that survived over the past 100 years. There was the US, Australia, and the UK, and the US did best of those 3. Many of the other major stock markets, they just obliterated, the Japanese stock market, the German stock market, the Russian stock market. So you have a lot of survivor bias whenever you're looking into that. So, Lyn, whenever we're talking about commodities, and I have this horrible habit where I'm saying, well, you should just buy this asset class. And I tend not to be very specific. And people are looking at me and like, so how do I do that? Let me give you that question. So if you're discussing, well, why not have an allocation to commodities? How does that work in practice?
So basically, there's different ways to do it. So my preferred way is to invest in commodity producers because I tend to be rather equity focused. So even when I'm looking at commodities, my first instinct and my best understanding is to look at the equities that are involved in commodities, which is mostly the commodity producers. You can also look at commodity transporters, things like that, the surrounding ecosystem. And so that's one of the better ways to do it because even in, say, flat or mildly up commodity environments, those companies are profitable, they're paying dividends, so they can kind of combine the commodity elements, basically the good inflation protection, with the compounding of a company. Now, they generally will have less compounding than like a software stock or a healthcare stock. So they, these are often not the best long-term performers, but they kind of combine that commodity element with that ability to also just compound and pay capital over time. So that's, I think, one of the better ways to do it. Also, I mean, you can just hold them indefinitely. They're an infinite duration securities, unlike, say, a contract with a specific date. Now, if you are active in futures, obviously they're another great way to play commodities. And the advantage there is that, for example, let's say your thesis is that governments are going to hamper energy companies' ability to produce more energy, right? For whatever reason, ESG reasons, whatever the case may be. Maybe you say, well, part of my thesis is that commodity companies are going to have a problem, so I just want to buy the underlying commodity. And so that's actually one way to clear out some counterparty risk, is to just directly get exposure to the commodity via futures. And so I think in a portfolio, the way I handle it personally is for most commodities, I go with the producers. For a handful of commodities where there's good ETFs or funds that are not futures-based. So the problem with, if you have an ETF-focused portfolio, a lot of those commodity ETFs use these rolling futures, and those are not the great long-term and hold investments. So holding specific futures can pay off really well. But if you hold like a commodity ETF through like a neutral to bear market, you can lose money on these rolling futures contracts. And so I generally avoid those kind of futures-based ETFs. So I either split it up to buying commodity producers like oil producers, copper producers, things like that, or I go and I buy a gold ETF, a silver ETF. There's even a uranium holding. It's a closed-end fund, similar to an ETF. So there's a handful of these commodities that you can get physical exposure to them, which is useful. And I combine that with the producers in many cases. And I personally mostly avoid the futures, but they are a very good way to play it if you're active in that market.
Yeah, I think that's an important thing to understand because most people might think, well, if they buy into, say, an oil future, it will be following the spot price. And that's just not the case because it's tied up to those futures. It's more expensive, and they might be thinking, well, I'm going to hold this for 10 years because I believe in the oil price going up over the next 10 years or whatnot. And then you have rolling futures that might be replaced once a month. And you're like, where's my return? I think it's important you brought that up. And also I would encourage listeners as they're going through this to make sure to check that, like what has the performance been on ETF compared to the spot price, and then also read up on whether or not if it's future based or not. When we're discussing equities, bonds, and gold and whatnot, we often tend to discuss how much the asset classes are manipulated, often but not only by central banks. Who are the big players in commodities, and are they being manipulated? And I also want to clarify, of course, whenever we say commodities, there are so many markets that can be defined as commodities. So perhaps we can start with that.
So with commodities, what you generally find is that the higher the stock to flow ratio of the commodity, because there's more of it available to rehypothecate and play with compared to commodities where, let's say you need 100 million tons a year worldwide and they produce 100 million tons a year, and there's not a lot of existing stock to play with, right? It's a very tight supply demand balance. They might have, say, 6 months in inventory. It's hard to move, and so basically something like the gold market is easier to manipulate than something like the copper market. Now, for those larger commodities, like let's say copper or oil, the main way that you can manipulate them is if you have a cartel of producers, right? So something like OPEC can manipulate even those low stock to flow ratio commodities. But basically, it's really hard to do because you have to have a quorum of the market. You have to have a meaningful percentage of global production, which is hard to do outside of the oil market. And so that's kind of been a long known purposeful thing in the oil market that's not really present in a lot of other commodity markets, in large part because it's such a key commodity. It's kind of the master commodity. It's even used as an input to get all the other commodities out of the ground. And so that's such a kind of the kind of the backbone commodity of modern civilization is these various fossil fuels. And so one way to manipulate it is to have that cartel. But then if you're doing the more like direct type of manipulation, generally it's limited to commodities that have that high stock to flow ratio. And so, for example, you can either have central bank manipulation or you can have commercial bank manipulation. And so commercial banks, there's been a number of them that have been fined for manipulating, gold, silver markets. You can do things like spoofing, where you purposely you put in limit orders and then pull them out. You're manipulating price. And then also because of, say, gold is very centralized, right? So over the time in human history, it got centralized in banks, and then it got centralized in central banks, and it's actually there's very large pools of it that are held by these major kind of vaults, like in London, in New York. And what you can do is you can basically issue more claims against it than you have, amount of gold that you could theoretically deliver now. And the problem there is that more people kind of think they own gold than really own gold. It's like a game of musical chairs where as long as things are working, they all get exposure to the gold price. There's no major risk. But it's like you could have a once every couple decade event where you have such a dislocation in the market that could break. And the most famous example is the London gold pool failing. That was kind of an intentional manipulation scheme to maintain the Bretton Woods system when it started to run into headwinds. But basically, even today, you have that rehypothecation problem where there's X amount of gold, but then there's, say, 5X amount of claims on that gold. And that size of that market can change over time. And it's kind of tied to the fact that, one, you have a high stock to flow ratio, and two, taking physical delivery is not easy. It's not a trivial process. You don't just get a UPS shipment in the mail. It's this whole detailed long-term delivery scheme. And so most players either just, they hold unallocated gold, so they have counterparty risk. And so there are manipulation that happens in these markets, but more so on that, say, the gold and silver side, and less so on, say, the copper, the nickel, markets like that.